The S&P 500 and Nasdaq renewed record yesterday, as usual, as technology mega caps extended their gains. The US yields and the US dollar remain soft ahead of the US inflation data due today, while crude oil rebounds on decline in US inventories and OPEC's improved global growth forecast. So welcome. This is Swissquote's Daily Market Talk. All right then, let's continue to count together. 37. Yesterday was the 37th time the S&P 500 hit a record high since the beginning of this year. The index rallied past the 5600 level to close the session above this mark for the very first time, while Nasdaq 100 flirted with the 20,700 mark, a fresh record as well, of course, as technology mega caps continue to push the major US indices to the uncharted territories thanks to a combination of encouraging semi-annual testimony that the Federal Reserve Chief Jerome Powell delivered earlier this week to US senators, and also on the back of promising industry news. So, Jerome Powell didn't say much more in the second day of his semi-annual testimony than he said in the first day. He didn't give a clear time target for, start to cutting the interest rates in the US, but he said this week that inflation is no longer the only risk to the US economy, that the cooling jobs market becomes something that the Federal Reserve policymakers are increasingly watching and maybe worried about, and that inflation doesn't necessarily need to sink below the 2% policy target for the Fed to start cutting the interest rates. So this does not mean that inflation is no longer a worry for the Fed. It just means that it is one of the worries right now. So today's CPI update from the US will still be very, very closely watched and monitored and determine the market mood, but investors will likely be maybe less upset to see any bump or blip in today's or coming months' inflation figures if other economic data, including growth and jobs data, for example, continue to show further weakness. So Powell's encouraging words and strong bond sales in the US this week kept the US yields under pressure so far this week, following a dive posterior to last Friday's soft jobs data. The US 2-year yield consolidates a touch above the 4.60% mark this morning, while it had been seeing solid support around the 4.70% level since May. The US 10-year yield hovers around 4.30% level as the US dollar index is getting comfortable below the 50-day moving average ahead of today's CPI data from the US. So, the latest CPI update is expected to show a softer headline inflation in the US compared to last month, with a fall from 3.3% to 3.1% on a yearly basis penciled in by analysts, despite a clear rise that we saw in gasoline prices in June and a steady core inflation at about 3.4%. So a set of data above expectations could obviously slow down the Fed dose and call for a correction in both equity and bond markets into the weekly closing bell, while figures in line or ideally softer than expected, if also combined with soft weekly jobless claims data from the US, should keep the Federal Reserve those in charge of the market to the end of the week, further boost appetite for bonds and pressure yields and the US dollar to the downside, and also give a further support to the equity rally. Now, according to Citigroup analysts who watch at the money straddles, the S&P 500 could move 0.8% up or down following today's CPI report. And if that's the case, that would be the biggest move for the index in a month when the last CPI data was printed and Fed announced its latest decision. And also note that smaller caps could also benefit from a possible post-CPI rally today, because yesterday even the Russell 2000 index rallied more than 1% on hope that the US could finally experience a relief on its rate policy sooner rather than later later this year. Now, the chance of a September rate cut in the US stands a little below 75%. However, while this probability was near 80% at the beginning of this week before Powell's testimony. So wait still until you pop the champagne. Now, diving into the stock rally. Well, yesterday's stock rally was again triggered by the US mega caps, the big technology stocks, as I said earlier in this episode. So semiconductors rallied on news that demand for AI boomed so much that it spurred 3.5 billion US dollar worth of export chips and related equipment from Taiwan last month. So this is a 422% surge from a year ago. So according to Bloomberg, the US was obviously the biggest destination for the Taiwanese shipments, Taiwan being home to TSM, which is Taiwan Semiconductor Manufacturing, and which is the biggest supplier of companies that we like Apple and Nvidia, with more than 74% of total shipments ending there from Taiwan. So TSM spiked to a fresh record in Taiwan today after announcing that its second quarter sales grew at the fastest pace since 2022, and that's revenue for June will reach something like 6.4 billion US dollars, which means a 40% growth rather than 35% growth expected by analysts. As such, Nvidia gained more than 2.5% at yesterday's trading session on expectation that a part of the TSM revenue will be reflecting in better than expected results for Nvidia as well, while AMD jumped nearly 4% yesterday. So the latest news come to defy those investors who expect earnings slow down from the leaders of the AI rally, as the earnings season is just about to kick off tomorrow with the big bank earnings. Elsewhere, Apple rallied nearly 1.9% yesterday to a fresh record level on news that it will ship 90 million iPhone 16s in the second half of this year, targeting a 10% growth in shipments compared to the previous model, partly thanks to its incentive to integrate AI tools into its devices, and partly thanks to weak comparison to 2023's weak results. So all that's left is to hope that the magic of AI works for Apple. Elsewhere, well, Japan's technology-heavy Nikkei index also advanced to a fresh record high this week as the Japanese yen remained under pressure despite a broadly softish US dollar. The European equities, on the other hand, gained some color at yesterday's trading session following French political shakes at the start of this week, while iShares MSCI China ETF consolidates losses after having stepped into the medium-term bearish consolidation zone 2 weeks ago, meaning that China is fully missing out the global stock rally and SAI giants remain extremely cheap compared to the US peers, but extremely undesired as well. In energy, US crude jumped after tipping a toe below the $81 per barrel level at yesterday's trading session, as the latest EIA data showed a 3.4 million barrel fall in US oil inventories last week, and as OPEC revised its global economic growth forecast slightly higher to 2.9%. So you make whatever you want out of the OPEC forecast, but a soft set of US inflation data today could eventually back a further rebound in oil prices. And finally, in the FX, the euro-dollar sees better appetite on waning French political risks on the currency and a broadly softer US dollar, while cable hits the highest level since March on the back of an improved political outlook following the general election and after the Bank of England's chief economist warned that, timing of a rate cut in Britain is still an open question. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market commence. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.